as we move on. In this section, we are going to discuss the expiration date and several other factors that are going to be important as we decide which option contract to use. As we dive deeper into the features of options, there are several other aspects that we need to start to address. The first one is the expiration date. This is going to be an important feature based on a couple of different things that we will get to as we move further along. The next is, how do we actually choose the strike price? That's always been a difficult thing to determine, and there are a few reasons as to why. The next will be all about moneyness. And I know that word sounds strange, however, it's not going to be too difficult to understand what it means. And we are then going to get into the premium. Why does the stock option cost the way that it costs? What are the features of it, etc. You have three different types of options. You have the monthly, you have the weekly, and you have the quarterly options. Options expiration is, as we understand, the time we have from when we purchase the option or when the option is listed on the exchange until the last day it trades and eventually is worth whatever the value is at that point in time. The first one and the most popular one tends to be the monthly. You then have, which is a bit newer, the weeklies, and finally you have the quarterly options. Monthly options are the most popular because they allow someone to take advantage of time value. However, they also allow you some time to make adjustments if need be, and they are usually the most valuable when it comes to generating monthly income. Weekly and quarterly options give the option buyer or the option seller more flexibility as to whether or not they would like to hedge against an earnings call, whether or not they would like to take a position on some sort of a product launch. For example, if Apple has announced it's going to do its annual product launch presentation, you may buy a call option or a put option, depending on what the rumors are within the presentation itself. Quarterly options are effective, however, they are not often used by individual investors. Individual investors that use quarterly options tend to implement them in more complicated strategies, for example, an iron condor or vertical spread. And we will get into all of those as we move on. So what are monthly options contracts, and what are the features, and why do they generally become the most popular option contract purchased? And when I say the word popular, the point I'm trying to make is that it usually has the most volume, which is important. They have strike prices that have more open interest, which we will get into as well. And they also provide the ability to hedge risk, generate income, and at some point in time and in certain situations allow the option buyer or seller to speculate. The expiration date of a monthly option contract tends to fall on the third Friday of every month. However, there are some months where it needs to fall on a Thursday because that Friday or that day that it's supposed to expire doesn't happen to land on that specific Friday. So you have at the month start, Jack decides to buy his option contract on the 10th of the month. Perhaps he thinks that Tesla's earnings are going to come out and he feels as though he'd either like to hedge his risk or he'd like to speculate on the outcome of the earnings report. Jack's option expires on the third Friday of every month, and then we have the month end. Most people question, why is a monthly contract expiring 3 weeks into the month? Well, remember, they are listed on the Thursday prior to that first week. So it does offer close to the full 30 days. However, it does not fall on the very last day of each month, since each month has a different amount of days. Let's discuss monthly options, the benefits and the drawbacks. I'm going to go through some of the definitions. I'm going to go through some of my thoughts, and then I will discuss in a little bit more detail how they can be used and applied as you start to get into your initial positions. Monthly options do tend to have greater stability. As we discussed, they do have higher liquidity, and it is easier to repair a losing position. Now, adding that last bullet point, easier to repair a losing position, I am going to come back and touch on, and that's a very important piece of buying and selling options. The drawbacks. Yes, you potentially have a lower chance on getting the rate of return that you would on a weekly option. And there are a few specific reasons for this. Greater stability. When you trade a monthly stock option, you are giving yourself several opportunities for the underlying stock to move both in your direction and certainly will be moving against your position, whether it's a call or a put. As we have discussed, and as I will continue to mention, your trading plan, having a monthly option gives you more time to accomplish what your trading plan requires you to do. Not all options need to be held to expiration, and most options are closed prior to expiration. If you purchase a monthly option and you are looking to make a 30% return on that, having 30 days to do so will actually give you more time to actually accomplish that. The higher liquidity aspect is it's easier to purchase a monthly option because not only are you in a marketplace with individual investors, you're also in a marketplace with more seasoned and professional investors. Buying weekly options is very risky, and you need to really have an understanding of what the underlying stock is going to do in order to make money on weekly options. Now, something we have not discussed yet, but we will be focusing a tremendous amount of time on, is time value. And the velocity of time value loss and time decay in weekly options makes it very difficult to accomplish what could be in most trading plans. And I want to mention this because it's important. However, I don't want to elaborate. Every day that passes, an option is going to lose a little bit of value, and the stock itself is going to have to do a little bit more just to keep up with the time decay. Easier to repair a losing position. If you are going to be buying and selling stock options, you are going to be in a losing position. It is a fact. If you go into purchasing or selling stock options and don't believe that you will ever be in a losing position, I would recommend taking it a little bit slower and not investing as much money until you get a real feel for the odds of being in the positions that you purchase being winners or being in positions that are losers. But again, mentioning the trading plan, I don't want to sound redundant, but without a trading plan, the weekly options are going to make it much more difficult to not just make money, but also lose money. Repairing a losing position is something that we will discuss in future lessons, but I want to discuss the tip of the iceberg as to what does that mean to repair a losing position. Let's suspect everybody in this course eventually buys a call option on Apple. If the stock moves against you, and that means if you buy a call option, we would like the stock to move up. And if you buy the call option and the stock moves down either that day and or over the next several days, you have time to either purchase that call option back at a lower price point and then buy it back or sell it out again, possibly 2 days later, could be the very same day, depending on how fast the stock moves. If you only have 3 days until expiration, for example, in a weekly, it's going to be much more difficult to close the position out that you're in and then go and find a strategy that will allow you to not only make your money back, but also not put you in another losing position. Fixing a losing position is simply where we go back to the marketplace and we think to ourselves, I wish I would have waited 15 minutes. And I suspect that everybody listening to me right now, including myself, will say that. It may not be 15 minutes, it may be 5 minutes, it may be 3 days, but you will eventually purchase an option or sell an option and regret not waiting. Having an expectation that you will be able to time when to buy and sell, by and large, at the perfect time, every time, is an unreasonable expectation that is going to cause you to lose money every single time. What I mean by that is you will be getting whipsawed around back and forth and doing the opposite of what your trading plan should say on the first line, which is to buy low and sell high. The potential for a lower rate of return or the return on your investment is something that I added because the features of a monthly option and what are referred to as the Greeks are not going to be as explosive. And I use the word explosive because of the fact that we have more time until expiration. With a weekly option, they are much less expensive. Whether they have higher liquidity or not is something that is really going to be stock dependent. But you would be able to find yourself purchasing something and it moving up 1,000%. And that's going to be very difficult to accomplish with a monthly option simply because of the way that they are priced, depending on when you buy them. If you buy them at the beginning of the month, it's obviously going to provide you with the lowest rate of return, assuming the stock moves in the direction you need it to move. Let's move on. So what are weekly options, often referred to as weeklies? Most new option traders suspect that weekly options are Monday through Friday. Actually, they are listed on the exchange the prior Thursday and they expire the following Friday. Let's say, for example, Jack is very interested in the movement of Apple after its earnings report next week. Apple tends to release earnings at 4:30 p.m. every 90 days on Tuesday of that week. He buys call options on Apple the prior Thursday, really feeling as though a couple of things in his situation he would like to have happen, and that is the stock will move higher going into earnings with the anticipation that it will either beat expectations and or just move higher into the earnings announcement. What you will find weekly options are used for is that specific strategy, and that is you don't want to buy the stock when it's at $500. You want to buy the stock when it's at $300 as it moves higher to 500. Oftentimes, the emotional aspect of buying and selling stocks really makes it difficult to buy the stock when it is down because we feel as though it's either not going to move higher, but more so, our body and our brain says it's not going to be worth that, and I don't feel it's going to be worth that until I see it as being worth that, meaning the $500 or $5, whatever the value of the stock is and whatever the value that you feel comfortable getting in. Buying a call option says, hey, I think it's going to move higher, and I do believe that during the next several days, Apple stock will move higher, causing my call contract to move higher, and I wait to earnings and see what takes place after hours. The company declares earnings on Tuesday. Jack realizes that his options are going to expire on Friday, taking it back to the trading plan and taking it back to the monthly options and a losing trade, but also giving you more time to not only start to understand how options work and move, but it also makes it so that you are not stuck in a position that is going to be very difficult to correct. Weekly options, especially on a week or during a week that has an event that is binary, meaning if Apple's earnings are not favorable and the stock collapses either after hours or the following day, the value of the call option that Jack purchased is going to collapse. And we will talk about the reasoning behind that, and we will talk about the reasoning behind why you are able to make significantly more money during the week with weekly options as you are against purchasing the monthly option. Apple earnings do come out, causing the stock to spike, and Jack decides to close the trade out after the announcement. This again is part of the trading plan. He may have exceeded what he wanted to make. He may actually have even exceeded what he wanted to make prior to the earnings announcement. If your trading plan calls for a 40% move higher in the call option position, you do not need to wait until Tuesday. That is an emotional reaction to thinking it's going to go higher. But as we know, if we've been in the stock market at all, we understand that although we hope and think that the company is going to go up in value, you could have met your required trading plan goal and then have the stock move against you, and now you've taken a complete loss. And speaking from experience with Apple and most stocks, if you purchase a call option or a put option and the stock moves in the position that is the opposite of which way you would like it to go, the option itself is going to lose a significant amount of value the following day. If it's on a Thursday, if you've met your goal, I would absolutely close it out prior to the earnings announcement or trim the position. Weekly options. Let's discuss the benefits and the drawbacks. So, lower outlay. With less time till expiration, the options are less expensive. Buying an option that is less expensive allows the stock movement to cause that option to move in a much more violent way, either up or down, and that's where these legendary stories come from, where you have an individual who bought something for $500, the stock moved up by $13, and they turned that $500 into $39,000. The flexibility to select a specific expiration date is also a very important piece, because if you buy a monthly and you do not want to be in the option for earnings, you can simply wait and after earnings purchase what would be considered a monthly option. Now, you don't necessarily need to buy a monthly option at the beginning of each month. What the monthly option is basically saying is the amount of time to expiration, and that is 30 days or so. With a weekly option, you've got the 8 days and are able to actually play an event, are able to hedge against an event, but you do not necessarily, you're not going to be stuck with having to make a decision with only a limited amount of days. Although monthly options are available on most stocks and exchange-traded funds, what we find is that the weeklies offer more strike prices. They are offered on what would be considered more stocks and ETFs. 300 plus different underlying investments is, in my opinion, enough to really focus in on a few stocks. I would recommend no more than 3. Studying them, watching their behavior throughout the week, the month, and understanding how they work. Let's talk about some of the drawbacks. There are going to be higher commissions, not because of a different price point, but because of the amount of trading that tends to happen when you buy weekly options. Weekly options will allow you to get into something, a current strike price that is $10 above the actual market price. You could meet your trading plan objective immediately, close the trade out, possibly do more research, possibly look at some of the technical aspects of the stock, and then re-enter in a different strike price at a different point of time, thus causing a higher commission. When it comes to option premiums, you are going to pay less and you are going to get more of an explosive move up or down. And if you don't get an explosive move up or down, you are still going to get a faster move up or down in weeklies. The flip side of that for option buyers is that 8 times out of 10, you're going to buy an option, and by the end of that week, it will be worth absolutely nothing, which is why I said that if you are in a position and you are looking to play a binary event, you don't necessarily need to wait until that event takes place if you have already met your objective. So as an option seller, you are not going to make anywhere near as much as you would make on a monthly. But like we just said, if you are selling an option, you are bringing in that first amount of money on day one, and that doesn't change. So knowing that 8 out of 10 options expire worthless, there's a high likelihood that you're going to sell weekly options and be successful most weeks. And if you look at the math behind selling a weekly versus a monthly, you will see that you are going to get a higher rate of return doing weeklies. However, when you sell the monthlies or the quarterlies, there's a higher likelihood that you are going to eventually have to either sell the stock or make an adjustment because you are now in a losing position. Weekly options. Very difficult to repair a losing position. The limited time to expiration makes it, the word challenging does not express and does not really explain and really drive the point home of how difficult it is to repair a losing position. Every day that passes, the option loses a significant amount of value, and as it's losing that value, what needs to happen is the stock needs to move up more than it would normally need to move with a monthly option. And think of it this way. Every day that passes, the stock needs to move higher and more quickly just to keep the option priced the same. If it moves higher, you're going to absolutely be in a position at some point in time, whether it's a call option or a put option, where the stock is moving in your direction, but it's not causing the underlying option to move with it. That's going to be something that we discuss moving forward. I think it's probably a bit too much right now to discuss why that is, but I do think that it's important to know that weekly options, they do tend to be difficult to repair. And what I have also found in my own personal experience and just what I have found in my research is in weekly options, you tend to make a very decent rate of return, or you tend to take a complete loss, which is why if you are going to trade weekly options, I strongly recommend putting a specific trading plan together to make sure that you are making the money that you would like to make in your winning positions, but more importantly, to close out a losing position prior to expiration. Even if you've taken a 50% loss, it is very difficult to fight against the emotions of either dollar cost averaging in and buying more. But also it's very difficult to say, well, it could move higher and I could make my money back. When you think that way, remember how important it is to say to yourself, every day that this stock and every day that this option gets closer to expiration, the underlying stock has to do something more extraordinary as time goes on. It needs to move up faster and it needs to move up more as time passes. Let's discuss quarterly options. A series of options that expire the last business day of each calendar quarter. These are more aimed at money managers, institutional investors. They typically rebalance their portfolios on the last day of the quarter. We are going to discuss why they use quarterlies. It usually is to hedge risk, but also to use and implement more advanced strategies on a larger portion of money. Quarterly options have a lot of benefits that I think are okay for retail investors, but I do believe that it is best to start with monthlies. However, as we get to the different strategies that you can use with stock options, quarterly options are actually going to be something that are probably the most intelligent selection. And it's going to make the most sense to do the strategies and implement them with quarterly options. Expiring on the last calendar day of the quarter is not a coincidence. What most institutional investors and money managers have to do is own a specific amount of something, whether that be stocks or bonds or commodities. And what takes place is they want to hedge risk. They need to report to shareholders during their quarterly reports, how did they perform? If you are in a stock that has a decent amount of volatility, or if you are in a stock that has several events that are coming up, you need to have a hedge in your portfolio. If you have bought Apple stock on day one of the second quarter, and your position as a money manager makes up 12%, you need to have some protection. So you may purchase a put option or a series of put options to protect yourself on the downside. The more advanced strategies are usually used when selling options. And the reason being is that selling options, you have the two different values, but we do have, as we discussed in earlier lessons, we do have some of the mechanics that make up options working in our favor that make it more attractive to sell, but we absolutely are going to earn a lower rate of return. But that rate of return, although lower, is going to be considerably more consistent. Right around the 90-day mark is right when, and usually when, the time decay starts to affect the price. Therefore, you can get into a position, maybe it's a covered call, maybe it's an iron condor, maybe it's a vertical spread, where you can more easily meet the rate of return your trading plan calls for, and it will be much easier for you to manage your emotions as you go on, because you're going to see that the movement in the stock is not causing that dramatic of a movement in the option. And that is going to be both on calls and puts. Let's talk about the benefits of quarterly options and the drawbacks. The expiration coincides with quarter end. These options are only available for a few major indices and ETFs. Their large notional size puts them out of reach for the average retail investor. And they do have a limited liquidity due to large notional value. Let's start with the benefits. The expiration coinciding with quarter end, enabling institutional investors to implement hedging strategies, it's a great feature because you're allowed to have your 90-day strategy set in place. It is something that you can implement and only have to implement 4 times a year, and you don't have to make as many trades. You do not have to make as many decisions if you were doing quarterly options as opposed to monthly. You can make your decision based on the research, based on your emotional state, based on your trading plan, and as the quarter starts and as the quarter goes on, even the most seasoned investors, even Warren Buffett, battles with his emotional response to how his portfolio is moving. If you do not have to make changes every day, then you are not having to manage your emotions every day. You are able to set in place your quarterly strategy and not have to really look at it or work on it throughout that quarter. The drawbacks. They are not available for most of the smaller stocks. You're going to find them on the larger blue chips. All of the Dow Jones stocks have them. You are going to find them on the most popular exchange-traded funds. But if you have a mid-cap or a small-cap stock that you would like to buy and hold and have some sort of upside potential, and or you would like to have some sort of downside protection, you are going to have to make more transactions and certainly buy the monthlies, as quarterlies are usually not available on those. Because of how much money they usually cost, a retail investor is going to reel it in and usually head towards the monthly options and decide that this is just too expensive, I'm going out too far. And whereas a money manager may look at that as an advantage to not have to make too many decisions, retail investors tend to look at that as there is a lot of time for something negative to happen, and negative could mean the stock goes up in value, but there is more time for something negative to happen in the stock, and I just don't feel comfortable doing that. And the liquidity aspect is also a problem. Liquidity in the options market is important because of the spread between the bid and ask. We have discussed that. We will discuss that in future lessons. All that basically means is there are fewer people in the market buying and selling. Therefore, they can charge higher and lower prices for each call option and for each put option. If you are looking at the strike prices, you will notice in quarterly options that there are a lot of bulk open interest positions in round numbers. And what that basically means is it's giving proof that it is something that institutional investors are really utilizing. Or you're going to see that that is where the more advanced strategies have a better marketplace and have better pricing for the options that they're looking to purchase for whatever they end up using as far as a strategy is concerned. I want to thank you again for joining me. Please stick with us as we are going to be moving on to section 3.2. Thanks again.